Now we begin our technical session to have a deeper understanding on the topic creating pension society in India. After listening to all the eminent dignitaries, now there are so many questions that triggering my mind. Is age makes a difference on our spending patterns? For example, education takes a lion's share expenses when one is between 30s and 50s. It falls after 50s. Unlike past generation, most modern urban Indians spend a lot on travel and recreation. This relative shift in expenses affect the retirement corpus. Now let's understand this. We have a panel discussion wherein I would request Sri Deepak Mohanty ji, who is a full-time member, Economics PFRDA, and former Executive Director RBI, to please come forward and moderate the session and introduce all our panelists. Welcome, sir.
Uh, Good afternoon, Honorable Minister of State, Dr. Bhagwat Kishan Rao Karadji, Economic Advisor, Government of India, Sri Sudhir Shamji, President ICAI, Chairman BFSI, Vice President ICAI, Chairman PFRDA, Sri Bandopadhyay ji, distinguished invitees. So it's my pleasure to introduce such a distinguished panel, and it's an honor to anchor this discussion. So this about 5 or 5, maybe will take about among us, including the Q&A session, so about 35 to 40 minutes, so that the session could be concluded on time. Mr. William Price is a global expert on the pension sector. Now, currently the CEO of D3P Global and advisor to many governments in terms of the pension. He has wide experience in this area, working in the World Bank, UK Treasury, UK Pension Regulator, with the OECD and also IOPS, and author of several speeches and books. Particularly, I may mention about saving the next billion from old age poverty. Very interesting, and then we'll be learning from that. He was also, secretary to Chancellor Gordon Brown. Rich experience from that point of view, and his education is from Oxford. So welcome, Mr. Price, so that we'll learn the international experience from you. I have with me Madam Behroz Kamdin, experience in a corporate law and taxation expert, currently with a partner in the Deloitte India, and she's been also associated with advising many corporates, and also with us. Madam, welcome to you to this discussion. For the sake of completeness, myself, whole-time member PFRDA, and I spent most of my life in central banking before moving to the pension sector. If I'm asked, Mr. Price, this is the question that we always face. Why pension? As was also mentioned by Chairman PFRDA, the young people, pension is far from their mind. And when you come to your middle ages, it's too late. Is that the kind of issue that is also faced globally? Your response to this query?
Thanks very much. And firstly, thanks. It's a great pleasure to be back on a panel with the PFRDA, with whom I've been working over a number of years. And thanks also to the ICMAI, the DFS and BFSI and the Honourable Minister. So the work we do that I've done on pensions, every country is different and lots of technical details, lots of very specific history and culture. I think probably the one thing which seems to be the same in every country is that the young people don't think about pensions. And I think probably young people have never thought about pensions. And so it's a kind of, I think it's a universal challenge. And I think as we'll get into in some of the discussions, it's why we all have to work to make pensions as easy as possible and as automatic as possible, And some of the things that India have done in terms of the digitalization, the link to financial inclusion, you have to make it so simple and hopefully so automatic that you don't really have to think about pensions, that you have a nice surprise when you're 40, 50, 60, not suddenly a bad surprise. So let me leave it there. I think it's also worth mentioning, though, that any system needs to mix public provision of pensions and private provision. So the NPS, the APY, everything that's covered by the PFRDA is incredibly important and will be increasingly important. There will always be in every country a sort of group of lifetime poor who, for whatever reason, probably will never make a contribution, what we used to call the kind of zero pillar. And so whilst we think about these conversations, it's always worth thinking that you need to have something for those who will have nothing. And the reason we called our book Saving the Next Billion is because the bottom billion, the people who are on the very, very lowest income in the world, will need something non-contributory so that they have a basic amount. But because that's so expensive, that's when you then move into the contributory and the private provision.
Yeah, I may just ask from your various country experiences, both in the advanced countries, I may like to pick a few, but particularly the emerging market countries like ours has a different challenge. And I understand you have also advised a number of emerging market countries. So we are about 2,200 US dollar per capita income. So it has its own challenges. Is there something different that we should be doing? What will be your advice?
I mean, I think the level of income has an influence in terms of how much people contribute, maybe, and how much you're aiming for. But I think actually the real lesson of a country like India is that you can do kind of world-leading things at any level of development. So the structure of the NPS, the unbundled architecture, the unique account, and the biometric ID are actually give you a foundation for developing pensions, which is very much better than many other countries. And actually, as we go around the world to developed or developing countries, we're often recommending a more this kind of architecture because it works very well in India in the way that it also works in parts of, say, the Swedish system. So there are some parts of pensions which are linked to the level of income and other parts which are not. So I think it's not so much the level of income, but as I say, trying to make it as efficient and simple as possible. And so, for example, when you have the investment approach, of course, you have many millions of people with very small balances. And if you go down a traditional route you see in lots of developed countries where it's kind of an individual market and people have to choose their investment strategy or having a financial advisor, there's not enough money to justify it. But it's too expensive to get that individual advice even in developed countries. And so the approach you have of the large pension funds, the separate auction and allocation process, investing at scale on behalf of those individuals, I think is very much the best one. And so there are many things I think that you should continue. And as I say, the kind of key thing is just to be gradually building out greater provision. And so we heard already about the APY and the various other developments that we've had over the years. I think one thing I would be thinking of doing in the Indian context, because you have this ability to create accounts and a unique account, would be sort of auto-creating a pension account. So everyone who's entering the workforce, say from 18 or 16 or when they're leaving, you could be saying to them, you automatically have a pension account. You don't have to do anything, it's already created for you. And even more with incentives, the government has some incentive there for you for when you make your first contribution or your first year's worth of contribution. So you could start talking about everybody has this thing. There's money waiting. If you contribute, you'll get more. And so there's something there where you have the capability and the ability to do something which may be quite dramatic and that other countries maybe haven't been able to do.
Let me just set out the broad contours of the pension sector, or that something like a social security, institutional social security, where pension could be a component, may not be adequate. But we see about 310 million people have some kind of access, which is about 22% of the population. And the assets under management would be about 33 trillion Indian rupees, which is about 14% of GDP. The entire pension sector, not only that what is in the regulatory jurisdiction of the PFRDA, which is there, and the bulk essentially is the Employees Provident Fund organization. But challenge again is that we have a labor force of 550 million. Out of that, 400 million are self-employed or casual labor who don't have any kind of a statutory backing in terms of social security, unlike in advanced country, because salaried wage employment is not there. And the pension universe, which is managed by PFRDA, what you spoke about, APY and then NPS also put together, about 49 million. Bulk of it, about 38 million, again, is APY. This is the unorganized sector, which covers about 3.5% of the population. And assets under management is about rupees 7 trillion, which is about 3% of GDP. So that's small number. And globally, when we talk about the global average, like the pension assets, more than 80% of GDP, and as you know, many countries, and including your own UK, which is more than 100%, is the as GDP is the pension asset. So there is tremendous potential. Of course, as was mentioned by Chairman also, that we are expanding quite well, that over 20% in terms of numbers increasing year on year. And the corpus also that we are managing is expanding more than 25-26% annually. Impressive as though the numbers are, but we have a long way to go in this whole process. And going forward, I mean, challenges are really huge. Large population, and increasing longevity that we have, increasing dependency ratio as you go forward and population start aging, and the breakdown in the basic traditional family system, because the families are getting more atomized, and then the challenge is largely of an informal sector. How do we bring them back into kind of a pension fold? So in this context, on the NPS side, that what we see, the government employees are already on board, so automatically they come in. So the segment that we will be talking about now is the corporate sector, and individuals, professionals, others who can really afford that. That number is quite tiny in that sense. That 1.4 million in terms of the corporates means I'm saying employees, not the number of corporates, and the all citizens model, the balance what we talk about 2 million. So basically added up the 3.4 million. Madam Behruz, so what's your take on this? What's going wrong? Because we are onboarding corporates, but the take-up rate seems to be quite low. So what should be done? What would be your advice on that?
Thank you, Mr. Mohanty, and thank you, Institute of Cost Accountants, for giving us this opportunity. These are my personal views, what I'm saying now, and not my organization views. So as far as increasing take-up rate, I think most important is people have to understand the importance of pension. And I am actually a beneficiary of pension at a very early age because of an unfortunate demise of my father. And he was working in a public sector bank. So we were eligible for pension. My mother got pension at that point. And if you are middle class, we don't have much savings. So all that which was there was provident fund, gratuity, leave encashment. We put everything into investment, and whatever returns we were getting was not sufficient enough. So though we may have these things which are there, provident fund, gratuity, leave encashment, that's not sufficient to get you the income per month. And that pension which was added to it really helped us in those times. Though now, after 20 years, maybe the amount is small and we think it's small, but it was very crucial at that point of time. So I think once a corporate understands that pension is important and they should look at financial well being. So I think a lot of things is now evolving from a corporate sector. Corporates earlier used to pay compensation for the services that they are rendering. Then they looked at the health well being of their employees. Now, a lot of corporates are looking at the financial well being of their employees. They want to retain employees, they have huge attritions. So, to cut down attrition, to have more employee engagements, to have happy employees, why not look at the financial well being of the corporates? Employees, and that's something which every corporate should look at whenever we work with with a person. If you are looking at his financial well-being, he's bound to be more loyal to you, give good service to you. So that actually expands further to most corporates. And what we believe is that there are 2 3 things which a corporate should do. Onboarding, that's the first thing which you should do. Of course, on onboarding, you catch them young, it's fine. Even when you do start pension at 30 40, also is fine. It's not that it's not fine, because you have a much more larger income and you can save higher. Every time in your lifespan, your work lifespan, you can always start with pension. But if you catch them early, it's much more better, it's much more disciplined, and you can do a proper savings of it. How do you go about doing it? I think everyone mentioned about incentivizing. I think corporates also need to have certain things to incentivize their employees. One was education resources. Have a portal done for your employees where they can actually see for financial well-being. The portal should be mainly for financial well-being. You have education materials put up over there, have trainings done for your employees, have speakers come and talk about financial well-being. How do you save? Pension is also part of saving. The way you save for mutual funds, you save in stock market, you save in fixed deposits, you also save for your pension. So they have to look at all of these aspects. What we've also seen some corporates do is reward employees for their excellence. Now I can reward an employee for excellence based on the amount which I give it to him. Some people now, some corporates give them vouchers. They give them vouchers for purchasing something. They give them vouchers for health benefits. Why not bear the cost of investment? Why can't corporates reward their employees or excellent employees by contributing to the savings what they are doing? Or you bear the cost of the of investing which is there, or you discount the cost. Certain corporates have so many employees, like large corporates have like 50,000 employees working with them. Discuss on how you can reduce the cost of investment, or you take up that onto account. So I think corporates also have to play a proactive role. You can't be sitting behind doing nothing. Every corporate has to play a proactive role for the financial well-being of its employees. Let them understand what are the returns, what are the risk involved in the returns, and all of that. And I think some other challenge which may come about as you compare a NPS with a provident fund or a recognized provident fund or a public provident fund, the main thing is people feel that it's secure. Whatever I'm investing, after 30 years, I will get that amount plus a return on it. When it comes to NPS, I think there's a lot of belief or perception that that amount can be risked because the investment is in stock market. There could be a risk attached to it. I have to understand that there's a risk attached to it, and therefore I'm getting higher returns. And therefore, how do I plan for my retirement? So I think somewhere this risk factor, if that is taken care, if there is a guaranteed return, or I can invest in government securities, and I think that's the best important thing which is there in NPS. They have a government security scheme also, and it is giving a very good return. If I can invest in government securities, have my corpus which is safe, then on the incremental, I can look at my stock market. So I think there are a lot of advantages which are there for an individual to put into NPS. Tax, of course, is there, which we'll talk about. But other than tax, also what we have seen is portability. I think NPS, when you look at NPS portability, it's not there with any other pension fund. Private pension funds, it's linked to employees. When you move, portability is not there. I left an organization, I worked for 8 years. I contributed. I didn't contribute, the employer contributed to the pension. But when I left after 8 years, I could not take it along. So it was a sunk loss for me. There was a condition that you need to work for 10 years to be eligible for pension at the age of 60, which I didn't complete. So that sunk loss is no longer there if it's NPS because it's portable. And that I think is the most important advantage. It goes along with the employee to various organizations. The second most biggest advantage is that you can choose your fund manager, you can choose your scheme. It is for you to choose that. That's the flexibility which is not there in other pension funds which are there. A flexibility given to you to monitor your investments and choose. And if you don't have the opportunity, or you don't have the time, or you don't have the wherewithals of doing it, put into government security. That leaves it safe and secure. So I think there are a few advantages of NPS and pension, which I think most people should understand. But there is a nudge which is required. So even though I have been saying this, I had the original pension, but in between I didn't have a pension. I was working as an employee. That time there was this provident fund. It's later on now when my son said, "Oh, everyone seems to be having pension around, and you're the only one who doesn't have." So it was a nudge which was required for me to start my own NPS account. And my son also has an NPS account. So I think that nudge is required from families, from corporates to have individuals open their NPS account. Thank you. Over to you, Mr. Mohanty.
Yeah, I think that's a very important point that you made, and you also laid out how flexible the scheme is and how portable the scheme is. And earlier, what distinguishes a formal, particular government job and non-government job, that government job you get pension, that's the kind of a thing that enhances prestige quite a bit. But the way now the design is, what the government gets through NPS government employees, anybody can really get that kind of a scheme on that design.
Yes.
And there are a lot of flexibility. But the other important point you mentioned about the risk, I think that's quite important, the perception of risk. The reality is very, very different. That if you see that you can have the full spectrum, that somebody completely risk averse goes into full GSEC, that choice is there. And since inception, the rate of return is annualized 9.1%. Nothing like that in the financial market that we have. And if you're getting into equity, it is 13.1% now since inception. Of course, we know the equity needs a longer staying power, and the longer cycle is there. You cannot do that in a hurry. So despite that perception of risk is there. Mr. Price, I don't see your video, but are you there?
So he's reconnecting.
Okay. Okay. So then, so Madam Behruz, in that sense, is there anything apart from the knowledge that financial literacy that we would have to expand? Is there anything we need to do to make this, you spoke about the corporate side, to make it more attractive to the citizens, and anything that we need to do? So that's one thing. The other thing, that mix between public and private, because various pension pillars, you see always there is a public component in the whole process. And the public component that we have here is that certainly the Atal Pension Yojana, which is guaranteed by the government. There again, the return also would surprise you, which is about 9.6% in inception, and it is a assured return, because it's a defined contribution and defined benefit plan, one of its kind. So public intervention is there. So do you think that there's a need to make it attractive to a common person? Is there a need for greater incentivization? And particularly what I'm hinting at is on the taxation side. That we need to do more, because as you know, that 50,000 straight away, there is a tax break one can take, which is additional on top of that, not available to any other savings schemes.
Yeah, thank you, Mr. Mohanty. So of course, incentivizing always helps, and I think government over the years have been looking at that. So if you look at it, government has always been giving deductions for savings in tax, and they have been incentivizing savings and investments, and that should continue. It's very essential that we have this sort of an incentive, and it's done globally. It's not something very unique to India. It's done globally. But government has also come out with another taxation scheme, which is a new tax scheme, which says don't claim any deductions and you could get a lower rate of tax. But what we have seen is that lower rate of tax is therefore very small, maybe in the lower slab brackets. Whoever is in the higher second or the higher slab brackets are better off by by claiming deductions, and any which way you're investing. So you're going to be saving. So why not claim the deduction for it? And of course, incentivizing in that manner does help. Now, when we come to tax, there are a lot of peculiarities to it. And if you look at it, you mentioned that you get a deduction for 50,000 rupees, which is being given. Generally, a retirement benefit plan should be a simple way of doing it so that you clearly get a deduction, and that's how it is. Then the question of taxation should come. If I'm claiming something from a taxed income and I'm saving, then maybe the return can be tax free. But if I'm getting a deduction and then I'm getting something, then maybe that could be taxed, because that's deferral of a tax. What would otherwise have been taxed now is being deferred to later years, maybe post retirement. But if you look at the way NPS is and the way our taxation works, we are getting a deduction maybe under 80cc1, 80cc1 and 2, mainly to the effect to say that whatever you contribute, if it's an employee who contributes it, then up to the limit of 20%, 10% of his salary and earnings allowance. An individual, when he contributes, up to 20% of his gross total income. However, within the overall limit of 1,50,000, plus you get a 50,000 limit. Of course, NPS 50,000, so clearly you get a tax benefit. And if you're in the highest slab bracket of 34%, you are saving immediately 15,000 to 17,000 rupees. So that's a clear saving that you're happening. And then you look at your return on investment. See, whenever we look at return on investment, we look at net of tax return on investment. Itna humko paisa mila, ispe itna tax ho gaya, and that's the balance, which is the amount which has got to us. So that's my net of tax return, which I'm going to be getting. And that is always, when we look at investments, have to be seen in that manner. Here you're getting a benefit. But what is happening to employer's contribution? Employer's contribution, when it's done, it is taken as taxable. Of course, you get the full amount as a deduction if it's less than 10% for normal employees or 14% for central government employees. So employer's contribution comes as an income, then I get a full deduction, it's not taxable. However, they have brought in a Finance Act 2020 to say that the employer's contribution will be added in the aggregate along with the employer's contribution to PF and superannuation fund. And if that aggregate exceeds 7,50,000, then the excess will be taxable. Now, this is a change which they've brought about in the Finance Act 2020. One thing has to be looked at is to say that, was there a requirement for NPS to be aggregated? Because NPS contribution for employers is already taken into account as my salary. Then can you again take that amount for aggregating for perquisite? That's the first question that comes to mind. The second question that comes to mind is, I opened the NPS account knowing that I'm getting certain tax benefits. Now, suddenly in some year, the act is changed. And then going forward, the contributions get taxed. It's going forward, contributions get taxed. But the account has already been opened on the understanding that it's not taxable. Now, suddenly something is going to get taxed out of it. So how does it work? Is it taking a retrospective or retroactive effect? Not retrospective, but retroactive effect on it. The third is on the accretal. Now, when I'm accruing any income on the NPS account, if it's the individual or employee's contribution, it is not taxable. But if it's the employer contribution, again, the accretal will be added along with the other accretals which are there for provident fund, superannuation fund. And then if it's in excess of the 7,50,000, there's a formula which has been given. The accretal become taxable. So there's a little confusion. Generally, retirement benefits, there should be simplicity attached to it. Here again, there'll be a little confusion to say, what is an accretal to NPS? Because I don't get dividends, I don't get interest. Is it the value in the portfolio which I have to take into account? What happens when the portfolio falls? There could be a loss also arising in a portfolio. What will happen in those cases? Will the loss be offset against the other accretals which are there? So there is a little doubt on that. But presently, the accretals on the value of the portfolio increase should be considered as an accretal. And if my overall contribution, employer's contribution is more than 7,50,000, then the accretal on that excess also needs to be taxed. So these are some of the nuances which are there in NPS. And if we really wish to have NPS as a retirement scheme, then we need to look at global. Are they doing it in this manner? Because when you look at global, generally what they go to is to say that, okay, if you're getting an exemption, a deduction in the first instance, the accretals are exempt. Whatever pension you receive will be taxable, which is fine because earlier it has been exempt, and you tax it. So you go by EET. In India, what is happening is I'm not getting a full deduction. because some part could be taxable, but I'm still paying tax on my pension. So that's something which has to be looked out. There should be a harmonizing of that whole factor. Most people will not get impacted because the limit of 7,50,000 is a very high limit of contribution. Maybe most people will not be impacted, and so it's only the very higher end is what they're trying to capture also in that sense. But it adds to complexity. That's the only thing which is there. There's a working which has to be done, has to be estimations to be done for withholding taxes, but there is a benefit. So benefit clearly is there, and that's where the employer comes in, that the employer's contribution for 10%, which is there, and if it's less than 7,50,000 in the aggregate, is not taxable. And that's something which an employer can look at when they're designing their salary compensations. And I think this is where the employers are missing out on it.
Yeah, I think that's very, very important. There is a need for harmonization and simplification. But once we are talking of the corporate and salaried class, so it is not the tax break that what the employee gets, but what is the incidence on the employer. I think that's an important point that you made on the taxation side. I could make just a brief point is that one is the education, financial literacy. Financial literacy globally is low, not only emerging markets and in India, and then once it comes to pension literacy, it is even lower. But I've been in the financial sector all my life till such time I moved to pension. I never wrapped my head around that and see the benefits and things like that. That has to be done, and it has to be done at all levels. And this conference that we are having is one of those things. Coming from professional bodies, it has a greater traction. Maybe industry bodies that they should do it, and we should have at the grassroots level, at the school and colleges, people get that kind of literacy, which is a big agenda, and then reach out to the people that we should be doing. With that, I think there's not much time, so we open it.
Just add one point, Mr. Mohanty.
Sure,
I think
sure.
on maturity. So we spoke of contribution, we spoke of the accretals. On maturity, I think it's very important. People need to realize that the maturity amount of the NPS, 60% is exempt from tax. And 40% I have to take a compulsory annuity, which again is exempt from tax. Of course, the annuity which you receive is taxable, but the amount that I put in annuity is exempt from tax. So the pension value which I get at maturity is tax-free. You compare this with your mutual funds which are there. Whenever you transfer a mutual fund or a stock, you're going to pay capital gains. So there's a capital gains tax on mutual funds and stocks, while there is no tax on the maturity value of the pension fund. Annuity, what you receive is a secondary investment that you do, and you receive annuity, that becomes taxable. But the first part of it is 100%. So I think that's very crucial for people to understand the benefits which government has given, and then take it to their employees, say, what are the tax benefits that you're going to get out of it?
Yeah, so thank you. So I think with the paucity of time, it is better to open up a few questions. Some
Sure.
issues will come up. So I'll request my colleague Mono to really handle that. And let's have few questions if time permits.